What's going on? Welcome back to another episode of the Paper Gains Show. I'm Johnathan Rankin, joined by my co-host Matt McGee. Matt, what's going on?
Not much. How are you?
Man, I'm good. I am just, like we were talking off camera. I'm reeling from the cost of kid camps. With my 8-year old and my soon-to-be 7-year old. It just seems like they keep going up in cost every single year, and the hours get shorter and more narrow of what they're actually doing with my kids. So it's fun. Gotta love summer, right?
That's right. Yeah, it's my first summer doing it, so I'm not as jaded as you have become, but I'll get there. Give me some time.
I'm very jaded. Summertime is like you realize, well, I could either spend money on camps for my kids, or I could just go on like a long family vacation and be gone for all of summer. And I keep telling myself, like, just leave for the summer, you'll save money. But then, who's going to do art projects with my daughter, and who's going to teach my kid how to play tennis, my son. So fun times. But that's not what we're talking about today. Today, we are going to be diving into ways to minimize taxes. This is a really big topic that we've gotten a lot of questions over the past couple weeks. And really for, those investors that are, that have had some sort of liquidity event, maybe they sold a business, or, they've had an asset in their family they've sold for, a large sum, but they've got to the point where they're really thinking, okay, I'm at the upper echelon of taxes, and it can't always be like this. There's got to be a way to pay Uncle Sam less. You hear all these stories about, these billionaires that pay zero income tax, and how do they do that? And those are the things that, we want to be able to just have that conversation about. Um, because taxes are something that I've never seen. I've never met a single person in my entire career who's ever wanted to pay more of them. So
Yeah.
it's, how do we minimize that? So
Yeah, and I think we're really going to focus on those predominantly in that, call it 5 to 20, 25 million. There, we'll talk about other categories or other asset sizes, if you will, in the future, but really wanted to hit on that segment, if you will. But I guess to jump right on in, I'm sure most people would think real estate. That's obviously one way to do it, but that real estate's going to kick off income. And so I think it really begins with like what assets you have, what type of accounts are they in, the stage that you're in, if you're still working, like to your point, the billionaires that aren't paying any taxes. One, that's because they set up foundations, so they're making significant charitable gifts. A large portion of their net worth is in single stocks. Like I'm thinking of Steve Ballmer that
yeah.
owns a huge amount, 100 plus million of Microsoft stock. So he's not getting paid by the Clippers per se. So like his income and wealth is tied to that stock. So he just has to worry about the dividends and interest from that stock. So it starts by taking a comprehensive look at your income sources, your assets, and then
It's
building
funny you say that, because
there.
it's really funny you say that. Sorry to interrupt. Is that,
Yeah.
what I've found is that people who are in that, really, that 5 to that $20 million, $25 million range of net worth, a lot of them have built their wealth through a business somehow. It's you probably didn't reach that 10, 15, $20 million wealth just being an employee somewhere. Usually a lot of them were
Mhm.
entrepreneurs. They built something. And that first step of getting things organized and just having an understanding of how are things, spread out, what entities, what businesses, what income sources do you have? That might sound fundamental, but the amount of people who haven't done that, because over time things just stack up. You might have
Yeah.
your first business that you might have a retirement plan through that, but then you also might have some brokerage savings, and then all of a sudden you might buy the building that your business is in, and now you've got the building, and then you have another business, and you end up looking up and you go, okay, I don't even know how many entities I've got. I have no clue the structure of things. And I want to pay Uncle Sam less, but I haven't even done the assessment of where do I stand today. And so I think that's a really good point of just taking a second to take a step back and take inventory, because at least a lot of the clients that I've worked with in that space, they will they'll hand everything over to the CPA, or the
Yeah.
accountant, or even us, and just say, okay, manage this or file this taxes, and here's all my stuff. But they don't necessarily understand, okay, where everything is. And so it's just, I think, having that first conversation, because I've had so many people that say, oh yeah, I forgot that I get $500,000 in income from this one thing. It's, well, that could push you up to,
Yeah.
a ultra high tax bracket.
Yeah. So I would say as it relates to this segment, the 5 to 20 million, exactly. Step one is laying it all out, visually seeing it, where the income is coming from. I'm thinking about somebody that was firmly in this camp that worked with for a number of years. They had significant, he was a business owner like most of these clients are, sells his business, so obviously that's a large one-time taxable hit, but that income now goes away. That call it $2 or $3 million gets invested into a trust or a brokerage account. But call it 10 plus million is in rental properties. So
Hmm.
that individual fully acknowledges that you're there's not a ton you can do for that. Like you can
Hmm.
depreciate the rental properties and do cost seg and all of that, but those are income producing assets.
Yeah.
And so I think some of it is, I call it step two of that is accepting and understanding there, depending on your situation, there's only so much you can or can't do. Like if you are a business owner and you sell your business for $5 million and you agree to stay on for a period of time, and you're so you've got that one time major hit that's likely a capital gain, but then you might have some sort of recurring consulting setup
Hmm.
that could pay out a couple 100,000 for a number of years. There's things you can do there that I've seen where if you set it up as like a single member LLC and set up a 401k cash balance plan for that CEO or executive, and that works if you're firmly going to stay for call it 3 to 5 years post
So
transaction.
explain, to the people listening. So what does that do? So they have this single member LLC. They set up, let's say, a cash balance plan or a 401k. Tell me, tell us, what does that actually do for them, and what's the benefit of that? Why would someone do that?
Yeah, so the benefits. Okay, to take a step back, you're Jonathan. You're selling your company to XYZ corporate company for $5 million. You're the CEO. You were the CEO of your company. You are no longer the CEO. You're now a VP, and you're making 500,000 a year for call it 5 years. If you do proper planning on the front end, so before a transaction is done and you negotiate as part of, hey, I'm selling for $5 million, I'm going to stay on, but I don't want to be a W-2 employee. I want to effectively be a consultant for 5 years. You're going to pay me 500,000. And so then you would have all of that consulting income be paid to your LLC. You're the only member of that LLC, so there's no employees besides yourself. And then you go out and set up like a solo 401k and cash balance plan for yourself. And maybe depending on your situation, you're fine deferring that income. And say you're a little older, say you're 55 or 60 at this point. Um, with that cash balance, given your age, you're likely able to defer a huge chunk of that 500,000. You're obviously going to have to unwind that at 73, but you don't have to pay taxes on that now.
Yeah. Okay. No, I think it's just important because I know, what I found is that people in that space, that 5 to 25 million, you hear that number and you go, okay, wow, someone on the street might say, you're extremely wealthy. But every time I talk to someone in that space, they don't consider themselves wealthy. Yes, they're probably well off and they're doing well, but they've also worked really, really hard. And
Yeah.
a lot of these people, they weren't just handed 10 or 15 or 20 million dollars. They worked long hours, they built a business, and they got to the point where someone valued that business and said, "Hey, we'd like to buy that out, or we'd like to acquire that." And so,
Hmm.
you get to that point and you go, "Well, I don't, do I want to defer this?" And all these different things can be really complicated. So that's why, I always find it, important to just really explain some of those details because, you know, someone with 15 or 20 million dollars, they might not feel like they're ultra wealthy at that point, and that's
Yeah.
where, part of the conversation that I've been having, especially with those in their 40s and early 50s about, that are in that space is estate taxes, and that's something
Yeah.
where they don't think, well, if you're in your mid 40s and you just got acquired for 10, 15, 20 million dollars, and now you've got this lump sum of money, you might not be at the above the exemption right now, but when you factor in 30 or 40 years of growth,
Yeah.
that's the part of, well, is that going to be a problem? Can that be tomorrow's problem, or should I start handling that today? So, what are some ways that someone could start setting something up to avoid some of those, estate tax issues that their kids might have down the road, and why might they do those things?
Yeah, so obviously a lot of this is in flux with the big beautiful tax bill that's still working its way through the system. But let's just assume the Tax Cuts and Jobs Act gets extended and the exemption stays high. It's effectively 14 million this year and looking like it'd be like 15 million next year is, I believe, what I've read. So to continue on with your example of the 40 to 50-year-old, I would obviously knock out your mortgage if you want to. Some people have very strong feelings about that. Uh, Fund 529s, kind of lay the foundation that gives you the ultimate flexibility in the future. So once all of that stuff is handled and education's taken care of, depending on if you're going to continue to work or if you're totally done working, for the most part, for people at that stage, I haven't seen a lot of irrevocable gifts like SLATs or anything like that. You predominantly see that at 65 plus, and even then,
So
I
what
feel like
let's back
people.
up one sec. So why don't you explain what is a slat for that 65, year old that
Yeah.
might be listening? What is a slat? How does it work, and why might they consider something like that?
Yeah, so a SLAT is a spousal lifetime access trust. It is a just a specialized trust for estate planning. Typically, you see it with a husband and wife or two partners that are that one they have taxable assets that are not in IRAs or qualified accounts. So that's step one. And it is a irrevocable trust. So it is a way to get significant assets out of your estate. So for somebody that is older and is highly likely to have an estate tax issue, this is just one way of doing it that is very effective. And so, say the exemption's 15 million to use easy numbers, and you had 30 million in taxable assets that a husband and wife could fund, two slats, one for each spouse, and you would fund it with 15 million apiece. You would It would be for the benefit of their heirs, kids, somebody like that is most common. It is out of your estate. You can the husband and wife can still receive some income from it. So that's a big part of it. Most people, especially in this demographic, making a irrevocable gift of that size, like that could be all of their assets. But so that's obviously something to consider. But so you can receive some income from it, and it's things to consider. Obviously, if you get a divorce, this is not a good idea, because that spouse can take that trust with them. So that's obviously the number one red flag to consider. But if you hit that category, you're 65 plus, or ready to make the planning like that a reality. A spousal lifetime access trust is a highly effective way of getting estates out of your estate, where they grow for the benefit of your heirs, outside of your estate.
Yeah, and that's the part where, you know, I don't know about you, but I've always found that the clients that are in their 40s and 50s, especially the entrepreneurs that have gotten to that point where they sold that business and they worked hard for it, a lot of them also aren't so inclined just to set their kids up on a free ticket, you know? And
Yeah,
so the
absolutely.
thought of doing things like, you know, the 529 plans for the grandkids when they start coming, those are things that are usually a little more challenging of a conversation. It's almost like same thing as you kind of mentioned charitable giving. It's like obviously we all, know that giving to a charity is a tax benefit, but a lot of people in that space where they really worked hard have a hard time being extremely charitably inclined, at least that I found. I mean, I
Yeah.
know I get that there's probably a lot of people that are, but the ones I've run across, they worked hard for their money, and they're still young enough to where they feel like I have another 10, 15, 20 years and probably I'm still working and doing something. So I'm still working hard. I'm not just going to give this away right now. So are these
Yeah.
things that, so that the slat is one idea that somebody down the road, when they're in their 60s do. Are there some strategies that, somebody in that 40 to 50-year-old camp should be considering if they're in that space to,
Yeah.
be mindful of that long-term, estate tax issue, but not give everything away right now because they just don't want to give it to their kids and put in their kids' name at this point.
Yeah. I mean, one thing that comes to mind that is I would consider more of a soft planning idea, but like say for let's specifically hit on those 40 to 50-year-olds that aren't looking to make irrevocable gifts. Say you set up a revocable trust, or even if it's in like a joint brokerage account,
Mhm.
um, and you're still in all likelihood still working, but you've had some sort of liquidation event or success. Uh, uh, Focusing, like being very thoughtful about your allocation, like it, obviously assuming risk tolerance is there and all of that, but like if you're trying to minimize taxes, like avoiding bonds, avoiding things that kick off income or dividends, uh, focusing on the buffered downside protection products. Those are things that are focused on growth that don't spit off income. And so obviously it depends wholeheartedly on your situation and risk tolerance, and it's a much broader discussion. But in an effort to, I would be very thoughtful in being very growth focused in your allocation that versus income focused. So that's some low hanging fruit. I mean, obviously there's things like tax loss harvesting during down markets to help offset, but like if we're really hammering that 40 to 50-year old, that I mean, one, laying it all out, having that conversation that like, hey, you are in the peak income years for the foreseeable future. One, that's a very good thing. That's what you worked extremely hard for. And then aligning each asset and account to accomplish the goals that it needs to do as tax efficiently as possible without giving it up or giving up control of the assets.
Yeah. And, I know one strategy that we've talked before about just individually, and that we've worked with clients on is, some of those premium financing, life insurance. So, do you want to go through what that strategy is and how that works to maybe be kind of that in between where you're not necessarily giving away the assets right now, but you're setting something up that would cover a good chunk of those estate taxes later on.
Yeah, yeah, that's another way of doing it. That's I would say, advanced planning topic. It's a way of uh, financing a like universal life policy with premium finance through a bank, with the idea of once you pass the death benefit helps pay off the loan, and all this stuff it flows to like an irrevocable trust outside of your estate to help pay estate taxes. And so it's it can be highly effective for those that for sure are going to have a future estate tax. For your example of the 40 to 50-year-old, that's assuming health and all of that. Like
Hmm.
if they're already at 10, 15 million at that age, like assuming that continues to meaningfully grow, and somebody like that might not have even received an inheritance yet.
Hmm.
So that would just further add to it. That those are things to definitely consider. I guess predominantly I've seen those in older individuals, but it is another tool, and it's just a way to finance and do that. But definitely in that 20 million plus
Yeah. And I
is
and I
where.
have seen it in some of the younger, that 40 to 50-year-old where, if you because you have to have assets there to essentially pledge. So if
Yeah.
once you have that liquidity event, if you are, let's say you're staying on and you're making an income and you just know, okay, well, I'm not going to touch this bucket of money that's invested for a long period of time, and
Hmm.
I can leverage some of that, then that's where it really can come into play. And, that way you can just have that be the kind of the collateral there because your lifestyle is going to be taken care of with the income you're making. So, it's definitely one strategy to consider. I just know that, you know, taxes overall, there's no magic bullet to say, okay, well,
Yeah.
here's exactly one way that, you can avoid paying all taxes forever. But, it's you may not like paying taxes right now on the income, but and you might not be thinking about, well, I don't care what my kids have to pay in taxes, but at the end of the day, it's still the money that you worked hard for. So
Yeah.
these are strategies that might not be necessarily as important to you because you're not going to see it on your W-2 or on your 1040 right now, but it's the estate side, and those can be some pretty large checks if you get to that point of estate taxes. So that's why we kind of go through some of this stuff. But I really like the idea of, the cash balance plan and doing that single member LLC and working through that if you're in that camp. Any other last minute ideas on, just ways to minimize taxes?
No, I think to drive the point home, specifically if you're in that demographic of 5 to 20 million, one that's both of our like sweet spot, if you will, and I would say it's underserved from a planning and everything that we just hit on for all the reasons that we debated, and those individuals, like you said at the beginning, they often don't feel that wealthy even though they are, but they might not, like the billionaire, like the billionaire has an army of family office attorneys, CPAs, advisors. They're firmly taken care of, but somebody like this, maybe they've had a good income their entire life, but their main asset is the business, and
Hmm.
so they were exceptional at their business, but maybe not that great at financial planning,
Well,
and
and
that's
it's
real.
funny you say that because I've also found that even on the tax side, and this is
Yeah,
what I found is that for the longest period of time, these individuals were working with a tax preparer, just somebody who's
yeah,
gonna, hey, give me the information. I'm gonna file it off. $800. It's gonna go to the IRS. I'm gonna take care of it so that you don't have to do it on TurboTax. But once you get to that point of, where you've got that 5, 10, 15, 20, $30 million, that's where you really need to do some tax planning, some tax
yeah,
consulting. And it's more than just preparation. Preparation is just, that's,
yeah,
for most business owners, they'll say that's like the $20 an hour job, whereas the consulting, that's the big paying job. So you want
yeah,
to make sure you're working on that side to really understand the plan, because that's what I found is that, not, they just haven't had those conversations of how do we set this up the right way? How do we do this from an institutional standpoint? Kind of like you said, with a billionaire, yeah, they have a family office, that has got a team of people. Well, you might have 5, 10, 15, $20 million, but you can still build out your team of people. And that's what we work with our
yeah,
clients on, to say, okay, let us, help quarterback that. We'll work and help you. If you have a good tax, professional, let's work with them and let's really try to enhance that conversation and just start throwing ideas that, just out there to say, what are some of the ways that we can structure everything to where we can minimize the tax burden, and really going through that. And a lot of it is, it's just poking around at different ideas to see if something will be applicable to that individual scenario, to that individual case, because you might have some real estate or some other business entities, and what kind of deferred compensation can we use on certain aspects of it. And there's just so many creative things you could do, but it really starts that planning. I can't emphasize enough, that's the biggest part of it.
yeah, yeah. I think that's a great place to end it, but this was fun to just dive into client scenarios and different things that we have seen as it relates to this segment of the market.
Yeah, it's really a fun, complex area. I love diving into this stuff. So, Matt, it was always fun chatting. And if you are listening to this, do us a favor, hit that subscribe button, join us as we put these out. And if you have any questions, our contact information is in the description. So reach out. We'd love to answer any of your specific questions on the show and help you out personally. But Matt, it's always good times, and we'll do it again soon.
Sounds good. See you soon.